Welcome to the Deep Dive. Today we're tackling a pretty critical mission, synthesizing the mountain of information from the Q4 2025 earnings call for TSMC.
The undisputed global leader.
Exactly, the undisputed leader in advanced semiconductors. This call, it was pre-market, January 15th, 2026, and it was always going to be huge, but I think the word is explosive.
That is exactly the right word, explosive. I mean, the market was already bullish leading up to this. TSM had significantly outperformed the index in the prior month.
Right.
But the narrative management delivered, it wasn't just a validation of the current AI megatrend. It was more like a blueprint for dominance. The themes were so clear. Technology leadership, unrelenting AI demand, and just an unprecedented capital investment strategy.
Okay, let's unpack this. I think we have to start with the headline numbers first because the company didn't just meet expectations.
Oh, not even close. They powered right past them.
So for Q4 2025, TSMC reported an EPS, this is the ADR equivalent, of $3.14. That's a massive 24-cent beat over the consensus of $2.90.
And the revenue is just as strong. They pulled in, what, 33.73 billion?
3.73. That beat the street by over $600 million.
And if you look at this through the lens of profitability, the numbers get truly compelling. I mean, gross margin for the quarter was 62.3%. Operating margin came in at 54.5%.
Those margins are stunning. They really are, especially when you think about the complexity of scaling new nodes and managing these huge global expansion costs. So why does a 24-cent EPS beat matter so much when expectations were already, sky high?
It matters because it signals true operational leverage. For months, the narrative has been that TSMC is the only game in town for the highest-end AI silicon.
Right.
This report confirms two things. First, that demand is absolutely insatiable. And second, that they found a way to translate that high-end demand into immediate, tangible profitability. The strength was explicitly and repeatedly linked to that favorable advanced node mix, which is almost entirely driven by high-performance computing, HPC, and AI.
Okay, let's focus on that margin story for a second. The 62.3% gross margin, that didn't just happen. It actually increased by 280 basis points sequentially.
And it exceeded the high end of their own guidance by 130 basis points. That is operational magic.
It really is. So what did they say was behind that?
Management cited three factors for that sequential jump. You had successful cost improvement efforts, a slightly favorable foreign exchange impact, and then the big one, a much, much higher overall capacity utilization rate.
Of course.
Think of it this way. When you're running a multi-billion-dollar factory, the closer you get to 100% utilization, the faster your profitability explodes, because all those fixed costs are absorbed across more wafers.
And the composition of the business tells you exactly why they are running at full tilt. Let's look at the actual business mix, because this is where you can physically see TSMC's competitive moat. Advanced technologies, which they define as 7 nanometer and below, accounted for a remarkable 77% of their Q4 wafer revenue.
That is a staggering statistic. It really is, and it's critical for you, the listener, to understand why 77% dominance matters. It's a historical high watermark, and it shows they are, almost entirely divorced from the cyclicality of the older nodes that still plague smaller competitors.
So their business is fundamentally tethered to the very complex, high-value stuff.
The highest margin products, exactly.
So how does that 77% break down, and what does it tell us about where the competitive pressure is landing?
We can break it down specifically. N3, or 3 nanometer, contributed 28% of wafer revenue, N5 was 35%, and N7 was 14%.
So the focus is clearly shifting.
It's all about N3 and N5, the primary nodes for current generation AI accelerators and high-end CPUs. And think about this. Other foundries are still trying to meaningfully ramp N5. TSMC is already generating a third of its revenue from it, and a quarter from the even newer N3.
That technological lead essentially ensures market share stability for years to come just because of the time it takes customers to design into these nodes.
Precisely.
Okay, diving into the platform mix, HPC grew 4% quarter over quarter. It now accounts for 55% of total revenue.
55%. It's huge.
And smartphone demand was also strong, up 11% sequentially to 32%. But that 55% figure for HPC is just overwhelming. Did management address the risk of being so concentrated in what's usually a pretty cyclical computing segment?
That's a crucial analytical question. And while HPC has historically been cyclical, Management's narrative suggests the AI component is fundamentally stabilizing it. They see AI demand as structural and multi-year, which essentially de-risks the traditional HPC cycle.
So it's not just about building PC chips anymore.
Not at all. They are building the infrastructure that everyone from hyperscalers to autonomous driving companies relies on.
Looking ahead, the guidance for Q1 2026 reinforces that extreme confidence. Revenue is guided to be between $34.6 billion and $35.8 billion.
And their margin guidance is maintained or even improved. Gross margin is expected to be 63 to 65%, and operating margin 54 to 56%.
Which implies that they expect capacity utilization to stay sky high and that favorable mix to just keep going.
They're effectively saying the AI-led upcycle is strengthening, even as all these major overseas expansion costs start to creep into the P&L.
Well, that massive Q1 guidance naturally forces us to look at how they plan to sustain that growth. And that brings us straight to the big structural themes: AI demand and capital deployment. Their full year 2026 revenue forecast is astonishing. We're talking close to 30% year-over-year growth in US dollar terms.
That figure is staggering when you consider the scale of the company. Yeah. It's double the growth rate they forecast for the broader Foundry 2.0 industry, which they expect to grow only 14% in 2026.
So they're projecting massive market share gains and secular tailwinds. And to achieve that 30% growth, they're spending money like water. The 2026 capital budget is guided at a massive $52 to $56 billion.
I mean, that is a truly major step up from the $40.9 billion they spent in 2025.
And what's most telling is where that money is going.
Right. 70 and 80% is allocated specifically for advanced process technologies, but they are also boosting their back-end capabilities.
Yeah.
They project that advanced packaging revenue will grow from around 8% in 2025 to slightly over 10% in 2026. 10 to 20% of the total CapEx budget is dedicated to supporting this back-end expansion, which is a major constraint right now.
So this aggressive spending isn't just a sign of confidence, it's a necessary reaction to demand. How high did they raise their forecast for the underlying AI growth?
They are completely all in on this AI megatrend. Management actually raised its forecast for AI accelerator revenue growth. The compound annual growth rate from 2024 through 2029 is now expected to approach the mid to high 50s.
The mid to high 50% range.
Yeah. It's practically unheard of for a segment this large. This also led them to raise their overall long-term revenue growth forecast to approach a 25% CAGR.
Those numbers justify the spending, but the discussion around capacity revealed the tightrope walk they are on for the next couple of years.
Absolutely. The capacity situation is extremely tight. And despite committing $56 billion, management stressed that volume production from these huge new fabs won't meaningfully narrow the supply and demand gap until 2028 or even 2029.
Why? I mean, what's the lag?
It just takes 2 to 3 years to bring a new fab online and qualify all the equipment.
Which means that for 2026 and 2027, output gains have to come from levers they can control today.
This is perhaps the most crucial operational note in the entire call. It means every basis point of margin improvement and every incremental wafer they produce for the next 2 years relies solely on manufacturing magic.
So what does that mean in practice?
It means maximizing manufacturing excellence, driving productivity gains within existing facilities, and optimize what they already have. For instance, converting some older N5 capacity to help satisfy the burgeoning N3 demand wherever possible. That's a huge, high-stakes operational lift.
Okay, let's talk about the technical roadmap, moving beyond the financials. They provided updates on their next generation of nodes, specifically N2 and this A16.
Yeah, so N2, the 2-nanometer technology, entered high-volume manufacturing in Q4 of 2025, and it's expected to ramp faster than N3 did. Its derivatives are key here. N2P and the A16 technology are scheduled for volume production in the second half of 2026.
For listeners who don't live inside a fabrication plant, the A16 features something called the superpower rail, or SPR. What exactly does that do, and why is it so critical for chips running these massive AI models?
Great question. The superpower rail is a huge design evolution. Historically, the power delivery networks, the wires that feed electricity to the transistors, were on the top of the chip, competing for space with all the signal wires. Right. SPR moves that power delivery underneath the transistors to the backside of the wafer. This massively improves power efficiency, it reduces voltage drop, and it allows for much denser signal routing, meaning you can pack more intelligence into the same chip area. For HPC and AI accelerators that run hot and need complex data flow, A16 is a complete game changer for performance and efficiency.
Shifting to competition, specifically the U.S. IDM that is trying to catch up, TSMC management expressed basically zero concern about market share loss. What is their structural argument there?
Their argument is simple. The complexity is their moat. It takes customers 2 to 3 years just for the design and verification phase to fully utilize an advanced technology like N3 or N2. Then it takes another 1 to 2 years for the production ramp.
So it's a huge multi-year commitment.
Exactly. It locks customers into their ecosystem. The switching costs, both in time and, well, in billions of dollars, make it virtually impossible for a major customer to abruptly jump ship, even if a competitor somehow manages to achieve process parity.
On that note, they also provided a critical update on their overseas footprint, specifically Arizona. This really confirms their commitment to global supply chains.
Absolutely. Fab 1 in Arizona is already in high-volume manufacturing as of late 2024. And due to stronger than expected demand, the schedule for Fab 2 was accelerated to the second half of 2027.
And this is where that nonverbal signal came in. They're already planning for a Fab 4 and a first advanced packaging fab in Arizona. They just bought a second large piece of land nearby.
Wait, buying a second large plot of land isn't just contingency planning. That's management placing a nonverbal multi-billion-dollar bet on AI demand, lasting far beyond their typical forecast window.
It's the clearest possible signal.
It really is. It signals that this accelerated demand and the resulting capacity tightness is structural, not temporary. They need that land to capture the accelerating AI demand they see extending well into the 2030s.
All right, let's pivot to the potential headwinds, because it wasn't a perfect call. They did forecast some potential margin pressure from the investment side.
They did, and this requires some careful analysis. They face margin dilution from 2 primary sources. First, the overseas fab ramp-ups are forecasted to cause a gross margin dilution of 2 to 3% in the early stages, widening to 3 to 4% later on.
Okay, that's one.
And second, the initial ramp-up of the N2 technology will start to dilute gross margin in the second half of 2026 by about 2 to 3% for the full year.
So if they're facing a cumulative 5 to 7% potential dilution from these 2 major structural changes, how do they mathematically sustain a long-term gross margin target of 56% or higher? What's the hidden lever here?
The only way to bridge that gap is through pricing power and extreme discipline. Management noted that the price increases they've seen blended ASPs were up roughly 20% in 2025. That was primarily used to offset inflation.
So tools, equipment, labor.
All of it. They're not being purely opportunistic. Their pricing strategy is guided by a focus on earning our value. They're using price hikes defensively to maintain their structural margins in the face of inflation and the inherent inefficiencies of starting up overseas fabs. This pricing power is another benefit of that technological moat we talked about.
Okay, here we are at the segment we call This Is Not Financial Advice. We offer this purely for entertainment and conceptual discussion, synthesizing the market dynamics into one outrageous but plausible trade idea based on the call.
The thesis here hinges on a simple fact. The market is still structurally underestimating the persistence of AI chip scarcity. We know capacity relief from that massive CapEx is delayed until 2028, maybe 2029.
Right.
We know the immediate bottleneck is advanced packaging, where they're stepping up CapEx. And we know management just signaled extreme long-term confidence by buying more land in Arizona.
So you synthesize those factors: scarcity, pricing power, long-term confidence. What's the trade?
The trade is to initiate a synthetic long position. So long deep in the money calls and short deep out of the money puts with a long 2028 expiration.
A long way out.
A long way out. The bet is that the stock's price momentum won't just fully digest the current 25% long-term SAGR guidance, but it will rapidly overshoot it. Why? Because utilization rates will remain near 100% for the next 2 years, and that pricing power will continue to successfully offset the overseas fab dilution.
And the volatility.
The implied volatility, which was just over 50% right after the call, should reprice significantly higher as the market wakes up to the fact that management's actions like buying that second plot of land signal a corporate confidence that extends years beyond the typical analyst horizon.
That is a phenomenal pitch, and it's driven by management's own nonverbal commitment. So, to quickly recap our deep dive into this Q4 2025 call, a major beat driven entirely by AI and HPC demand, an aggressive $52 to $56 billion CapEx plan that sets the stage for supply relief in 2028 or 2029, and the confirmed strength of that long-term AI accelerator, HEAGR, approaching the mid to high 50s.
The final provocative thought we'll leave you with is this. If TSMC's manufacturing excellence is the only lever preventing a massive supply collapse over the next 24 months, what does that operational limit mean for the pricing power and future design choices of every major AI company reliant on them?
A great question.
Are we seeing a fundamental shift from AI is driving hardware demand to TSMC's operational limits are now dictating the entire AI industry's speed and cost structure?
Question that turns the entire investment thesis on its head. Remember that this analysis is based purely on the information provided in the earnings call materials and is not and should not be construed as financial advice. Thank you for joining us for this deep dive. We'll catch you next time.